This system is incredibly unfair. It requires everybody to become a part-time investor to figure out where is the money flowing, because if we don't, then the impact on our long-term wealth is massive. Now in this video, we are going to look at macro trends, charts that you probably have never seen before. We are going to look at the S&P 500. We're going to look at this relative to gold. We're going to look at this relative to money printing. And we're going to find out that it actually does matter to time the market. Now here's why everybody is forced to become a part-time investor. You probably have seen this before. This is the value of $1,000 in 1913 measured with the official inflation numbers today. Had you not invested your grandfather's $1,000 over the span of more than 100 years, you're now left with $31 worth of purchasing power in today's money. And the reason for this is the expansion of the money supply. Over time, there's more and more dollars that gets printed. That happens due to issuance of new loans. And because the monetary base is expanding like this, the value of the US dollar approaches zero over time. And so there's many ways to protect against this, right? We can buy stocks, we can buy gold. Let's have a look at the performances relative to monetary expansion over the decades. And let's also clean up a few myths. One myth, for example, is that gold is much safer than stocks. Is that really the case? Check this out. This is the gold price over the long term. This chart starts in the 1970s. And temporarily in the 80s and 90s, the gold price actually went down by 70%. The maximum drawdown that we saw in stocks during that same time period was only 50% roughly. So this is the S&P 500. And during that time period, we've even gotten some dividend yields. So actually, if we just look at the maximum drawdown top to bottom, stocks had been less risky compared to gold. Gold isn't necessarily the safe haven, right? If you simply just save in gold as opposed to stocks. Now here's another way to look at this. This is another gold chart, but this time we divide this by the US money supply. Again, let's have a look at the worst case scenario. You buy the top, you sell the bottom. Now we are not just looking at a 70% drop. Relative to monetary expansion, gold actually lost 90% during those 20 years. So this puts some perspective on what long-term investing means, right? If you hold over 20 years, if you hold gold over 20 years to protect yourself against monetary expansion, you can still lose 90% temporarily. And so yes, both gold and the S&P 500 tend to be somewhat protecting against monetary expansion. So gold didn't gain or didn't lose anything against monetary expansion over the course of 65 years. And yes, the S&P 500 relative to monetary expansion did win a little bit. It's a gain of roughly 40%. But how sustainable is that gain really, since the volatility is so high? And so since timing the market does matter quite a bit, let's try to figure out what causes those kinds of waves. And because holding fiat currency over the long term, even if it's just 10 or 20 years, is not necessarily an option, let's instead look at opportunity costs. So let's try to find out, when does it make sense to be rather in gold versus in the S&P 500? What causes those waves? The first line that we see over here in 1971, it shows a relative bottom in the gold price to the S&P 500, which then outperformed the S&P 500 by 1,700%. And what happened over here, the cause of this gold rally was the Nixon shock. So this is when the international convertibility of the US dollar to gold got cancelled. This was when everybody was freaking out about the value of the US dollar, right? You can't anymore fix convert your US dollars into gold coins. So the US dollar really became a fiat currency, a currency that's backed by nothing, right? Only by the faith in the US government. That's what caused this run into gold. And so gold outperformed not just monetary expansion, but also the S&P 500. Then something in the 80s here happened. Gold crashed relative to stocks by 97%. Again, those waves really matter. What happened during that time? The start of the tech boom happened. So technology stocks outperformed even the S&P 500 quite a lot. And then around the year 2000, the dot-com bubble burst. And that's when gold was able to outperform the S&P 500 again. By more than 700%, by the way. The second vertical line here on this chart is when Bitcoin launched. So some people say that Bitcoin became a replacement for gold. How much this is true is up to speculation. Gold, since the launch of Bitcoin, underperformed the S&P 500 by 65%. Now let's have a look again at the S&P 500 and let's have a look at it relative to US monetary expansion. And let's focus on 2 points in time. One point when stocks had been historically relatively cheap, and another point when they had been relatively expensive. During that time, stocks outperformed monetary expansion by roughly 5x. So we've got December of 1979. That's over here in this chart when gold was very expensive. And we've got June of 1999 or the 2000s. That was when gold was very cheap. So it seems like capital tends to flow from gold to stocks and back from stocks to gold. And so here is a super simple way to potentially time those tops and bottoms. This is again gold versus the S&P 500. And what we see over here is the 8-year moving average. Now there's really no fundamental reason why I took 8 years. It simply just fits the data coincidentally quite well. So we would go into stocks when the relative valuation of gold versus the S&P 500 falls below the moving average. So we spare ourselves from an 85% decline. And then we buy into gold whenever momentum turns bullish and we make a more than 500% gain. So yes, we might be sometimes late to the party and we only protect ourselves against an 86% decline and we miss this first 60% drop, but it's still better than just buying and holding and owning everything with the same portfolio weighting all the time. Now, when we currently zoom into this, we should still rather prefer stocks to gold. Because interestingly enough, the kinds of supports that we've seen in the past also work now. But we are getting pretty close to potentially buying back into gold again. We need gold to outperform the S&P 500 by only 5 to 6%, which isn't much in the grand scheme of things. Now, let's say you are a super long-term investor and you really do not care about 97% underperformance of parts of your portfolio over the course of 20 years. Because really, you're at the beginning of your career, you're maybe in your 20s, and you're only buying for retirement once you're maybe 60 years old. So I still regard 20 years as short term. This is of course a very extreme scenario. But let's work with that. Or let's say you don't believe in timing the market whatsoever, even though these swings are so massive. This video is sponsored by the Premium membership. I never take any money from any crypto project. I never take any affiliate links from centralized exchanges. I never pump and dump coins. Instead, I offer valuable tutorials in the Premium membership. Feel free to check it out. And so let's say you really wanted to only decide, should I buy gold or should I buy the S&P 500? In that case, gold, of course, historically underperformed the S&P 500. This is over a very, very long time frame though. And so let's annualize this. We start off with the gold price being roughly 2.3 times the value of the S&P 500. It then goes down to 0.45. This is over the course of 119 years. This is annualized an underperformance of 1.4%. Since the S&P 500 is a price index and not a performance index, we also have to add dividends. The average dividend yield of the S&P 500 is 2.86%. It's currently way lower. It's 1.3%. I believe it's going to stay low because the weighting of technology stocks becomes more and more important, and technology stocks tend to pay less dividends. They tend to reinvest more. So I don't think we will go back to 2.8%, but let's still work with that average number. Historically, over the decades, stocks underperformed gold by 4.23%. Monetary expansion annualized, by the way, is 6.9%. So there is a case to be made to forget about gold altogether and to simply just dollar cost average into the S&P 500. That being said, the swings are pretty large. And if you have a time horizon of 40 years, that's a strategy that can work. If you have a time horizon of only 10 or 20 years, it might not work that well. Because again, the S&P 500 relative to monetary expansion can drop by 73%. The S&P 500 relative to the gold price can drop by 95%. Again, those swings are much larger on the relative valuation charts because sometimes money flows into gold, sometimes it flows into stocks. So there is some kind of a pendulum effect here. And currently, gold relative to the S&P 500 is rather cheap. Historically, we haven't been that low for quite a while. That being said, the momentum isn't yet positive, but it could turn around rather quickly. Now, this is a channel about crypto, so why do I start talking about stocks and about gold, etc.? It's because I believe it is important to own more than just one asset, right? Let's say you buy Bitcoin and then Bitcoin drops by 70%, which it easily can, and you don't have anything into any other asset. You don't have anything invested in tech stocks or in gold or in long-term government bonds. You're just solely focused on crypto. Then you don't have the opportunity to take advantage of those drops, right? You can't buy the crash except just with your regular cash flow. But if your wealth is already relatively large compared to your cash flow because you have been saving for a while, it's very important to be able to buy also besides just with your cash flow, right? It makes sense to then maybe sell some of your gold or long-term government bonds or stocks to buy the dip. And so this video simply just points towards what to potentially buy in order to diversify away from crypto. Gold is somewhat cheap, but it's not yet seeing any positive momentum. And so given that it does cost 4% per annum to own gold over stocks over the many decades, I think it makes sense to still own stocks, but to potentially reconsider this once there's a shift in mass psychology again. Because this is really what drives the waves. It's greed versus fear. It was fear of the implosion of the US dollar after the Nixon shock. It was greed when technology stocks started taking a hold. And it was again fear when the dot-com bubble burst and the global financial crisis started. Now we still seem to be in greed mode, but that might turn around in the not so distant future. If you learned something in this video, feel free to give this a like. I publish videos regularly. Feel free to also share this with your friends. If it's your first time here, feel free to subscribe as well. I publish videos regularly. If you've got Telegram, feel free to join us as well. It's 100% free. The link is down below. Looking very much forward to chatting with you. Cheers.